73 million Americans get their water from a private company, not from their city, not from their county, from a corporation, one that answers to shareholders, not residents, one whose primary obligation by law is profit. Most residents don't choose this. In many cases, they were never asked. Over the last 2 decades, a quiet transfer of power has taken place across the United States. One city council vote at a time, one distressed municipality at a time, the water that flows through American homes has been moving from public hands to private ones. The companies acquiring these systems are not small local operators. They are billion-dollar publicly traded utilities backed by institutional investors managed for maximum return. And they have spent millions lobbying state legislators to make buying your water infrastructure easier, faster, and more profitable than ever before. This is the story of how it happened, who built the system, who profits from it, and what it means for the 73 million Americans who have no alternative. To understand how private companies came to control a public resource, you have to understand the problem they claim to be solving. America's water infrastructure is old. Much of it was built in the mid-20th century, some of it earlier. Pipes corrode, treatment plants fail, and the cost of fixing them has become staggeringly high. The American Society of Civil Engineers has documented that a water main breaks somewhere in the United States every 2 minutes. Every single day, an estimated 6 billion gallons of treated water, water that has already been cleaned, tested, and pressured through the system, is lost through leaks before it ever reaches a home. For small municipalities, towns with aging systems, shrinking tax bases, and no capital to fund repairs, this is not a theoretical problem. It is an immediate fiscal crisis. When a town cannot afford to replace its pipes, it has limited options. It can raise taxes, it can take on debt, or it can sell. And this is exactly what private water companies have been counting on. Beginning in the 1990s and accelerating sharply through the 2000s and 2010s, investor-owned utilities began systematically identifying distressed water systems, particularly in smaller towns and mid-sized cities, and approaching local governments with an offer. We will buy your system, absorb the liability, fund the repairs, and take the problem off your hands. On the surface, it sounds reasonable, but what those municipalities were selling was not just aging infrastructure. They were selling the permanent right to charge their residents for water in perpetuity, with a guaranteed return baked in by state regulators. In other words, they were selling a captive customer base with no ability to choose a competitor, and they were selling it cheap. 3 companies dominate the American private water market. Understanding who they are and who owns them is essential to understanding what is actually happening. The largest is American Water Works. It serves more than 14 million people across 14 states and 18 military installations. It is publicly traded on the New York Stock Exchange under the ticker AWK. Its largest institutional shareholders include Vanguard, BlackRock, and State Street, the same asset managers that own significant stakes in virtually every major American corporation. The second is Essential Utilities, formerly known as Aqua America, the parent company of Aqua Pennsylvania, one of the largest private water providers in the state that has become the epicenter of water privatization in the United States. The third is Veolia, a French multinational and the largest water company on earth. They operate water systems on 6 continents. In 2022, it completed a merger with its primary European rival, Suez, creating a water and environmental services giant with revenues exceeding 40 billion euros annually. In late 2025, American Water and Essential Utilities announced their intent to merge. The combined entity would serve 4.7 million customers across 17 states and carry a combined valuation of approximately $40 billion. If approved, it would represent the single largest consolidation in the history of American water utility privatization. This is not a regulatory footnote. This is the creation of a near monopoly over an essential resource, one that regulators in multiple states will have to either approve or block. And the companies are already arguing that the merger will bring efficiency, lower cost, and better infrastructure investment. They made the same arguments in every city they have ever acquired. The records tell a different story. A comprehensive survey of 500 water systems, the largest of its kind, conducted by the advocacy organization Food and Water Watch, found that private water companies charge, on average, 59% more than publicly operated systems. The average public utility charges roughly $316 per year for a typical household. The average private utility charges nearly $501 for the same amount of water. In some communities, the increase came within months of a sale. In others, it was phased over several years, but it came. The same research found that after privatization, water rates increased at approximately 3 times the rate of inflation. After an average of 11 years under private control, residential water rates had nearly tripled. That is not a coincidence, it's the business model. When a private company acquires a water system, state regulators allow it to earn a guaranteed rate of return on its capital investment. The more the company invests in infrastructure, real or nominal, the more it is permitted to charge customers. The incentive is not to keep prices low. The incentive is to invest, claim a return, and raise rates accordingly. It is a structure that was designed ostensibly to encourage private companies to fund necessary improvements. In practice, it has become a mechanism for extracting sustained profit from communities that have no choice but to pay. Private water companies do not acquire systems through market competition. They acquire them through legislation, lobbying, and careful cultivation of relationships with elected officials who control whether a sale can happen at all. The most important piece of legislation in the history of American water privatization is something called fair market value law. Traditionally, when a municipality sold a water system, the sale price was calculated based on the original cost of the infrastructure minus depreciation. This kept prices low and limited the profit potential for buyers. Fair market value legislation changed that calculation entirely. Under these laws, private companies are permitted to pay and subsequently charge ratepayers for the full appraised market value of a water system, regardless of what it costs to build. In practical terms, this means a company can pay dramatically more for a system than recover that cost through higher rates charged to the same residents who once owned it. As of today, more than a dozen states have passed some version of fair market value legislation. In many of those states, the legislation was drafted with direct input from the water utility industry and passed with the support of legislators who had received campaign contributions from those same companies. Pennsylvania is the most documented example. Pennsylvania American Water, a subsidiary of American Water Works, has been one of the most aggressive acquirers of municipal systems in the country. Between 2015 and 2017 alone, investor-owned companies purchased more than 100 water and sewer utilities nationally. Pennsylvania led the country. The States Act 12, passed in 2016, formalized fair market value pricing for water system acquisitions in Pennsylvania. In the years that followed, Pennsylvania American Water announced plans to acquire 6 additional systems in 2025 alone. The revolving door between the water industry and state regulatory agencies has been documented in multiple states. Regulators who oversee utility rate approvals frequently move into senior roles at the companies they once regulated. Lobbyists for water utilities draft model legislation that is introduced with minimal modification by state lawmakers. This is not unique to water. It's a pattern that recurs across privatized industries. But when it happens with water, a resource with no substitute and no opt-out, the consequences are uniquely severe. One official from the advocacy organization Food and Water Watch put it plainly. Companies may be offering large sums of money to entice local officials to sell assets, but that is not free money. It is a debt that constituents will pay through their water bills for generations. In 2014, the residents of Flint, Michigan began noticing something wrong with their water. The story that emerged, lead contamination, government negligence, a public health catastrophe, became one of the most reported environmental stories of the decade. It was framed, almost universally, as a failure of government, a cost-cutting decision by a state-appointed emergency manager, a breakdown of public accountability. That framing is not wrong, but it's incomplete. What is less often reported is the context in which the Flint crisis occurred. A city that had been systematically defunded, whose infrastructure had been allowed to deteriorate for decades, and whose financial distress made it exactly the kind of target that private utility companies actively seek out. Flint did not become a cautionary tale about privatization because it was privatized. It became a cautionary tale about what happens when public systems are starved of investment until the only options are crisis or sale. In communities that have sold, the pattern is consistent and documented. Rates increase, often by 30 to 80% within the first several years. Infrastructure investment is announced, but frequently delayed. When residents complain, they are directed to a customer service line operated by a company headquartered in another state. In Missoula, Montana, residents voted in 2011 to use eminent domain to reclaim their water system from a private operator after rates rose and service quality declined. The legal battle lasted years and cost the city millions. They eventually won, but most communities that try to reclaim privatized water systems do not win. In Johnson County, Illinois, residents saw their water bills triple after a private acquisition. State regulators approved the rate increases. Residents had no legal recourse. A Pennsylvania court ruled in one case that regulators should not have approved the sale of a municipal sewer system, finding that the deal would have caused rates to double. The ruling was seen as a significant win for opponents of privatization. It was also an exception. The fundamental problem is structural. When a private company owns your water system, it does not compete for your business. It cannot lose you as a customer. You cannot switch providers. You cannot move. You pay what the regulator permits the company to charge, and in state after state, what regulators permit has risen steadily since privatization accelerated. There's also the matter of what private ownership does to transparency. Public water systems are subject to open record laws, public meeting requirements, and direct electoral accountability. When a system is sold, the mechanisms disappear. The new owner's internal finances, executive compensation, and infrastructure decisions are proprietary. The public, in other words, loses the right to know what's being done with their water or their money. The American Water and Essential Utilities merger is not a future possibility. It's happening now. Shareholders of both companies approved the transaction in February 2026. American Water shareholders voted 99% in favor. Kentucky approved the merger in April. Ohio approved it in May. The companies are targeting a close date of the first quarter of 2027, pending federal antitrust clearance and remaining state approvals in Pennsylvania and New Jersey. A single corporation serving 4.7 million water and wastewater customers across 17 states. The largest consolidation in the history of American water privatization, and it is clearing regulatory hurdles with almost no public debate. The companies have said publicly that rates will not change as a result of the merger. They've also said that the combined entity will be better positioned to invest in infrastructure and serve communities more effectively. These are the same assurances that have been given before every major acquisition in the history of American water privatization. The rate data that followed those acquisitions tells a different story. Meanwhile, in states across the country, additional fair market value legislation is under consideration. Water utility lobbyists are among the most active in state capitals where aging infrastructure has created conditions for acquisition. The pipeline of distressed systems available for purchase is not shrinking. And there is one more dimension to the story that rarely receives the coverage it warrants. Rainwater harvesting is technically legal in all 50 states, but in Colorado, residents are capped at collecting just 110 gallons total, roughly enough to fill 2 bathtubs. Utah caps collection at 2,500 gallons and requires registration with the state. Across the western United States, water right laws rooted in 19th century prior appropriation doctrine hold that precipitation belongs to existing rights holders, not to the person whose roof it lands on. The legal architecture is different from state to state, but the underlying logic is consistent. Water in the United States is not simply a resource, it's a property right, and those rights have been systematically accumulated by corporations, utilities, by institutional investors over more than a century. A publicly traded corporation can charge you for the water that comes out of your tap. Raise that price with regulatory approval year after year, and in parts of this country, the law will restrict how much rain falling on your own property you are permitted to keep. 73 million Americans, one essential resource, a corporate consolidation that has been in progress for decades, largely without public debate, in the rooms where local governments make decisions that most residents never know are being made. The question is not whether water should be profitable. The question is whether a resource that no human being can survive without should be subject to the same logic as any other investment: extraction, return, and growth, and whether the answer to that question should be made by shareholders or by the people who drink it.